been asked to discuss what are the biggest challenges in the Australian lending space and how we can overcome this. Obviously, it's no surprise things are getting a bit difficult out there, so I just wanted to talk about some ways we can get things moving and also talk about some solutions we might have for you. Who is Picker Financial Solutions? What do we do? So we act as mortgage brokers. We specialise in investment lending and we're essentially the in-house mortgage brokers for Deleen Property. Team of 10 staff, so we're really growing and obviously adapting to the market conditions, which is awesome. And also we're active in property investors ourselves. So there's not too many brokers or brokerages out there that have quite large property portfolios. And obviously you can leverage our experience personally and professionally, which is what we do and we pride ourselves on. What are the challenges right now? Obviously, higher interest rates have gone up. Philip Lowe said nothing was going to happen up until 2024-25 with 2% interest rates. That all went to with obviously the inflation data, so things went up very quickly and everyone's been feeling that pain. Looks like we're at the peak at this point, which is great. Economists still get paid millions of dollars and they f it up. They can't accurately predict it, but it looks like we're at the peak at the moment, which is great. So those high interest rates obviously have reduced how much we can borrow, but also the inflation data also increased our living expenditure. So what that meant is that, our money of 100,000 before is going a lot less. 200,000, that type of income is getting less and less. On top of that as well, you've got servicing buffers. So when you go for a loan, if the interest rate was 2%, the stress test was 3%, so a total of 5% is how the bank would assess you to make your repayments. What then happened is we're past that when the rate's now at 6% and everyone who had their loans at 2% was beyond that stress test mean. Now with the rate of being 6.5%, there's a 3% buffer, so you're being assessed at like 9.5%, which is pretty rough. Some lenders have brought that down to like a 2.5% buffer, but you're still being really serviced a lot higher than what you're actually going to be repaying. So pretty rough on that side too. Also mortgage prisoners, right? So you had a lot of people who bought at the top of the market. In Sydney, there's not enough equity release because things have cooled off and then they can't refinance, they can't get away. What that kind of means is that, they're stuck with loans or there's not an option they've got out of there that's not suitable to their scenario. And they're really feeling the pressure. So we've seen a bit of that too. Probably the biggest one is the more competition, and I'll jump into some graphs pretty soon about the inflation and some data and things like that.